Imagine two apple trees standing side by side in an orchard. The tree on the left is dropping fruit everywhere. The ground is covered in red apples. You can fill basket after basket without climbing a ladder. It looks incredibly productive. The tree on the right? It barely has any apples at all. Maybe one or two hanging near the top. But if you look closer at the tree on the left, the productive one, you notice the trunk is hollow. The branches are brittle. It is dropping so much fruit because it is dying. Meanwhile, the tree on the right has doubled in size since last year. This is the exact trap investors fall into when they confuse yield with growth. One feels like wealth, the other actually creates it. Today, we are going to fix the single biggest misunderstanding in your portfolio: the difference between the fruit you eat and the tree that grows. I see this confusion constantly. Someone buys a stock because it pays a 7% dividend, or they buy a rental property because it has high cash flow. And then they wonder why their net worth has not budged in 5 years. They are looking at the wrong number. We are going to break this down using total return, which is the only number that actually matters. If you want to stop chasing shiny objects and start building a real orchard, do me a favor and hit the subscribe button. It is the best return on investment you will get for your time today. Let's get into the difference between the fruit and the tree. Let's start with yield. In our visual metaphor, yield is the fruit. It is the apple you can pick off the tree, polish on your shirt, and eat right now. In financial terms, this is the cash income an investment generates for you while you hold it. If you own a stock, this is the dividend check that hits your brokerage account every quarter. If you own a bond, it is the interest payment. If you own real estate, it is the rent the tenant pays you every month after expenses. The defining characteristic of yield is that it is realized cash. It leaves the investment and enters your pocket. You can spend it on groceries. You can pay your electric bill with it. Because it is tangible, it feels safe. It feels real. But focusing too heavily on this feeling of safety is exactly where the problems begin. Here is the math, and it is simpler than Wall Street wants you to think. Yield is just a ratio. It is a snapshot in time. You take the annual income, let's say a stock pays $3 a year in dividends, and you divide it by the current price of the stock. If that stock costs $100, your yield is 3%. Simple. But here is the trick. That percentage changes based on the price. If the stock price drops to $50, but the company still pays that same $3 dividend, your yield suddenly jumps to 6%. On paper, that looks twice as good. But in reality, you just lost half your capital. The yield went up only because the asset value crashed. This is why you will often see terrible companies sporting massive dividend yields. It is not generosity. It is a math error in the investor's favor, masking a disaster.
Why do we love yield so much?
I have thought about this a lot. I think it is because yield validates our decision to buy. When a dividend creates a notification on your phone saying, "You received $50, your brain releases a little hit of dopamine. It feels like a paycheck. It feels like you are getting away with something, getting paid for doing nothing. It addresses a primal fear that the money we invest might disappear. Yield says, "Look, here is some cash back. You are safe." It appeals to our desire for immediate gratification. We can see the fruit. We can count the apples. The problem is that the stock market does not care about your dopamine levels. And often, the investments that soothe your anxiety today are the ones that starve your retirement tomorrow. This leads us to the yield trap. Let's go back to our orchard. You see a tree dropping hundreds of apples. It looks like a bounty. But the reason it is dropping everything is that the roots are rotting. In the stock market, this is called a value trap. You might see a company with a 10% dividend yield. You think, even if the stock price doesn't move, I make 10% a year. That is the trap. Usually, the market has priced that stock low because everyone knows the dividend is about to be cut, or the business is dying. If you buy that stock for the yield and the price drops 20%, your 10% yield does not help you. You are still down 10% overall. You bought the apples, but you bought them on a burning tree. Never buy an investment solely for the payout without looking at the health of the thing paying you. So, if the fruit can be a lie, what about the wood? What about the tree itself? Most people think growth is just gambling, that a price will go up. But growth is actually a mechanical process, not a gamble. If you ignore this next part, you are going to miss out on the most powerful force in finance. Let's talk about the invisible money. Growth, or capital appreciation, is the tree getting bigger. In our visual, this is the trunk thickening, the branches spreading wider, and the roots going deeper. It is the increase in the value of the asset itself over time. If you buy a house for $300,000 and 10 years later it is worth $500,000, that $200,000 difference is growth. Unlike yield, growth is not paid out to you. It is stored inside the asset. You cannot spend it at the grocery store unless you sell a piece of the tree. This makes it feel less real to new investors. It feels like paper money. But for wealth building, a thick, healthy tree is far more valuable than a basket of apples. The math of growth is where the magic happens, and it comes down to compounding. Yield does not naturally compound unless you manually reinvest it, which triggers taxes and fees. Growth compounds automatically. Think about the tree. If the trunk grows 10% this year, it is now a bigger trunk. Next year, if it grows 10% again, it is growing 10% on that new, larger size. In the stock market, a company that retains its earnings, meaning it doesn't pay a dividend, is taking that cash and ploughing it back into the business to build new factories or develop new software. They are using your money to make the tree bigger. Over 10 or 20 years, this exponential curve destroys the linear return of simple yield. A high-growth asset can double, triple, or quadruple in value, dwarfing the income you would have received from dividends. The psychological hurdle with growth is patience. It is literally like watching a tree grow. You look at it every day and nothing seems to happen. You don't get that dopamine hit of a cash deposit. In fact, growth can be volatile. The price of your tree might swing up and down based on what the neighbours think your tree is worth that day. This volatility scares people into the safety of yield. But growth investing is the ultimate test of the marshmallow test. The idea that if you can wait for the second marshmallow, you win. Growth investors are people who don't need the money today. They are willing to let the tree get massive so that in 20 years they can sell the lumber for a fortune. It requires a mindset shift from income now to wealth later. There is another hidden benefit to the tree over the fruit. The taxman can't eat the wood while it is still growing. When you receive yield, dividends or rent, you usually have to pay taxes on that income in the year you receive it. That is a drag on your returns. It slows you down. But with capital growth, you typically don't pay a cent in tax until you actually sell the asset. You control the timing. You can let that money compound tax-free for decades. In many jurisdictions, capital gains taxes are lower than income taxes too. So not only does the tree grow faster because you aren't chopping off branches to pay the IRS every year, but you also get to keep more of it at the end. Focusing on growth is often the most tax-efficient way to get rich. Now, you might be thinking, Tom, why can't I have both? Why can't I have a big tree that also drops lots of apples? You can, but there is a mathematical reality that dividend investors hate admitting. It is called the dividend irrelevance theory, and it proves that receiving a dividend is mathematically the same as selling shares. If you don't understand this next concept, you will think you are getting free money, when you are actually just moving money from your left pocket to your right pocket. Total return is the only scoreboard that matters. Total return is simply the sum of yield plus growth. It is the apples you picked plus the growth of the tree. Many investors look at a stock that is down 5% and say, it's a bad investment. But if that stock paid a 7% dividend, your total return is actually positive 2%. Conversely, and this is more dangerous, you might look at a stock that stayed flat, price didn't move, and think it did nothing. But if it paid a 10% dividend, you made 10%. You have to look at the whole picture, the basket of fruit plus the lumber. Stop looking at just the price chart and stop looking at just the yield percentage. You need to combine them.
Let's look at a concrete example using two imaginary companies.
Company A trades at $50 and pays a 10% dividend. That's $5. Company B trades at $50 and pays only a $2.50 dividend. After a year, Company A's stock price drops to $45. You get your $5 dividend. Your total value is 45 plus 5. You have $50. You made 0%. Now look at Company B. It grew a little bit, up to $47.50. You get your smaller $2.50 dividend. Your total value is $47.50 plus $2.50. You also have $50. The total return is identical. The guy holding Company A felt like he was getting rich because of the big dividend checks, but his tree was shrinking. The guy holding Company B saw his tree grow. In the end, the math was the same. Yield and growth are just two levers on the same machine. Here is the mechanic that blows people's minds. When a company pays a dividend, the stock price drops by the exact amount of that dividend. It has to. The cash is leaving the company's bank account and going to yours. The company is now worth less cash. If a stock is trading at $100 and pays a $2 dividend, on the ex-dividend date, that stock will open at $98. It is not free money. It is a forced liquidation of part of your holding. So when you scream, "I love dividends," what you are really saying is, "I love forced partial withdrawals from my portfolio." That is fine if you need the cash. But if you are in the accumulation phase, you are just taking parts of your tree, chopping them off, paying tax on them, and then trying to glue them back on by reinvesting. So what is the protocol here? How do you use this? Simple. Ignore the yield column when you are judging performance. When you compare two ETFs or two stocks, toggle your chart settings to total return. Most brokerage apps default to price return, which only shows the growth of the tree and ignores the fruit. This makes dividend stocks look worse than they are, and growth stocks look better than they are. You need the adjusted data. Always judge an investment by how much richer it makes you in total. Price plus income. If the total return is lower than a simple index fund, it doesn't matter how juicy the yield is. A losing strategy with a high yield is still a losing strategy. We have talked a lot about stocks, but this concept actually matters more in real estate. This is where I see people lose hundreds of thousands of dollars in opportunity cost. They buy a cheap apartment because the rent covers the mortgage and they feel smart. Meanwhile, the guy next door buys a house that costs him money every month, and 10 years later, he retires while the first guy is still chasing tenants. Let's run the property numbers because the data here is shocking. In property, we call yield rental yield and growth capital growth. Let's say you have $350,000 to spend. You could buy an apartment in a city centre that rents for a huge amount, let's say a 10% yield. You are cash flow positive from day one. Or you could buy a house in a high demand suburb with land. The rent is lower, maybe only 4% yield. You might even have to chip in a few bucks a month to cover the mortgage. The apartment is the fruit-heavy tree. The house is the growing tree. Most beginners pick the apartment because they are terrified of negative cash flow. They want the passive income immediately. But let's look at what happens over 15 years. Data from Opes Partners and Blue Fox Finance modelled this exact scenario. They found that over a long horizon, say 15 years, the high-growth property destroys the high-yield property. One analysis showed the high-growth strategy resulted in 24% more total wealth. Why? Because properties with high yield often have low appreciation. That apartment might be worth $350,000 today and $400,000 in 10 years. The house? It might double to $700,000. The gain in the asset value completely overshadows the rental income. A rule of thumb developed by Blue Fox Finance is that 1% of extra capital growth is worth roughly 1.5% to 2% of rental yield. Growth does the heavy lifting in real estate. The rent just keeps the lights on. The capital gain makes you rich. And again, we have to talk about taxes. Rental income is taxed at your marginal rate. If you're working a job and earning a good salary, adding rental income on top might mean losing 30, 40 or 50% of that fruit to the government every year. You are running on a treadmill. But the increase in the property's value? That is usually not taxed until you sell. And in some places, if you hold it long enough or never sell, you can leverage against it without triggering a tax event. You can borrow against the bigger tree to buy more trees. You cannot borrow against a basket of apples. The efficiency of growth in a leverage-heavy asset class like real estate is unbeatable. So, does this mean you should never buy for yield? No, but you have to understand the trade-off. If you buy the high-yield property, you're buying a job. You're buying an income stream. If you buy the high-growth property, you're buying a wealth engine. The data suggests that for most people in the accumulation phase, sacrificing a bit of yield to get better quality assets with higher growth potential is the winning move. Don't let the lure of an extra $50 a week in rent blind you to the $100,000 of capital gains you are missing out on. We have covered the math and the traps. Now we need to answer the big question. Which one is right for you? Because the answer actually flips depending on your age. A 20-year-old using a 60-year-old strategy is a disaster. Let's map this out so you leave here with a plan. If you are under 50, or you are still working and don't need income from your investments to buy groceries, you are an accumulator. Your goal is to build the biggest orchard possible. You do not care about the fruit yet. In fact, fruit is annoying because you have to pay taxes on it and find a place to put it. You should prioritize total return with a heavy tilt toward growth. You want assets that compound internally. You want companies that reinvest their profits, not companies that pay them out. You want properties in areas with land scarcity that will appreciate. If you focus on yield now, you are stunting your tree's growth right when it needs to be expanding. You are eating your own seed corn. Now, if you are retired, or you have won the game and just need to pay your bills, the script flips. You are a decumulator. You have a massive orchard. Now you need the apples. You might shift your portfolio toward higher yield investments, bonds, dividend aristocrats, commercial real estate. Why? Because it is psychologically easier to spend the income than to sell the shares. It feels safer to eat the fruit than to chop off a branch, even if the math is technically the same. This is where income investing shines. It protects you from having to sell assets during a market crash just to pay for electricity. It provides stability. But here is a pro tip for the retirees. You don't have to switch to high yield. You can create what is called a homemade dividend. If you hold a massive growth portfolio and you need cash, you just sell 2% of your shares. But Tom, I'm selling my assets. Yes, but if the assets grew by 8% and you sell 2%, your tree is still bigger than it was last year. This approach allows you to stay invested in high-quality growth companies while generating the exact cash flow you need. It gives you control. You decide when to create the dividend, rather than waiting for a board of directors to declare one. It requires more discipline, but it often results in a higher legacy value left over for your kids. For most of us, the answer lies somewhere in the middle, but likely tilted toward growth more than you think. A balanced portfolio might have some foundational yield for stability, but the engine is growth. Do not let the internet convince you that cash flow is king. Cash flow is just one part of the total return kingdom. Net worth is king, and net worth is built by owning things that become more valuable over time. Focus on the tree, water the roots, be patient, the fruit will come. So, next time you see a flashy double-digit yield, picture that rotting tree. Ask yourself, is this paying me because it's generous or because it's dying? And next time you see a stock with zero yield, don't dismiss it. Look at the trunk. It might be growing the wealth that will change your life in 20 years. If this apple tree analogy helped you visualize your money better, I'd love to hear about it in the comments. Are you a fruit picker or an orchard grower? Let me know below. And if you want to see how I analyze specific stocks for total return, make sure you are subscribed so you don't miss next week's deep dive. Thanks for watching, and I'll see you in the next one.